Thank you, Deborah. I'd like to call this meeting of the FDIC Board to order. We have several items on the summary agenda today. Are there any questions or comments on the summary agenda? If none, may I have a motion to approve the summary agenda?
So moved.
Thank you. And a second?
Second.
All in favor, please say aye.
Aye.
Those opposed? The motion is adopted. We have one item on the discussion agenda today. It's a memorandum and resolution relating to the proposed statement of policy on Bank Merger Act transactions. Rayanne Miller, Sharita Holland, George Small, Ben Klein, and Ryan Singer will present the case.
Good morning, Chairman Grunberg and members of the board. My name is Ben Klein, and I am Supervisory Counsel in the Bank Activities Unit of the Legal Division. Staff recommends that the FDIC Board of Directors approve for publication in the Federal Register a proposed statement of policy on bank merger transactions. The proposal would replace the FDIC's current statement of policy, last revised in 2008. It would update, strengthen, and clarify the FDIC's policies and expectations related to the evaluation of transactions subject to FDIC approval under the Bank Merger Act. Further, the proposal reflects legislative and other developments that have occurred since the current statement of policy was last updated. This includes the enactment of the statutory factor regarding the risk to the stability of the United States banking or financial system. If approved, the proposed statement of policy would be published for public comment with a 60-day comment period. The Bank Merger Act is codified within the Federal Deposit Insurance Act and creates a statutory framework requiring regulatory approval in connection with a variety of transactions. The FDIC occupies a special role within this framework as it has exclusive jurisdiction over any merger transaction involving an insured depository institution and a non-insured institution. For transactions between two insured depository institutions, the Bank Merger Act divides responsibility among the three federal banking agencies. The FDIC has jurisdiction to act on such transactions in cases where the resulting institution is FDIC supervised, meaning a state non-member bank or state savings association. In addition to conferring jurisdiction for acting on merger transactions, the Bank Merger Act sets forth the scope of transactions subject to regulatory approval. The proposed statement of policy would provide transparency and clarity to the public by providing a non-exhaustive overview of different transaction structures that implicate the Bank Merger Act. These include transactions that may not be legally structured as mergers, such as purchase and assumption transactions that constitute mergers in substance, as well as transactions that may not be thought of as mergers in the conventional sense, such as a transaction that consists of an assumption of any deposit or other similar liability. The Bank Merger Act then sets forth a variety of requirements that must generally be satisfied in connection with a transaction subject to regulatory approval. These include public notice requirements and a general requirement that the Attorney General provide a competitive factors report for transactions among non-affiliated entities. In addition to the Attorney General's competitive factors report, the FDIC conducts its own competitive analysis on transactions subject to its approval. This is done in order to ensure that a transaction does not violate the Bank Merger Act's prohibition on bank mergers that would result in a monopoly in any part of the United States, or that would otherwise have anti-competitive effects, unless such anti-competitive effects are outweighed in the public interest. At the heart of the Bank Merger Act are specifically enumerated statutory factors that must be considered in connection with a merger transaction. The competitive considerations just described form the first statutory factor. In addition, the FDIC is required to take into consideration the financial and managerial resources and future prospects of the existing and proposed institutions, the convenience and needs of the community to be served, the risk to the stability of the United States banking or financial system, and the effectiveness of any insured depository institution involved in the proposed merger transaction in combating money laundering activities, including in overseas branches. The Bank Merger Act requires that the FDIC consider each of these statutory factors. Significantly, the FDIC's delegations of authority authorize FDIC staff to approve merger transactions only if each statutory factor is favorably resolved. The FDIC Board reserves authority to act on any merger transaction for which one or more statutory factors are not favorably resolved. This includes denying a merger application. The proposed statement of policy would provide transparency and clarity by communicating the Board's expectations for merger transactions subject to FDIC approval, including the analytical considerations that go into evaluating each statutory factor. And now I would like to turn to my colleague from the Division of Risk Management Supervision, George Small, who will describe those analytical considerations and the proposal's supervisory approach to evaluating merger transactions.
Thank you, Ben. As he had said, my name is George Small. I'm a senior examination specialist in the Division of Risk Management Supervision in the policy section. I'll take a few minutes here to talk about statement of policy in general terms and then begin a discussion on the statutory factors. The proposed statement of policy includes new content, frames the FDIC's responsibilities under the Bank Merger Act, addresses each statutory factor separately, and highlights other matters and considerations. The proposed statement of policy is more principles-based and communicates the Board's expectations regarding merger applications filed pursuant to the Bank Merger Act. The proposed statement of policy addresses each statutory factor individually in a forward-looking manner. The proposed statement of policy refines and in some cases broadens the description of the analytical considerations for each statutory factor. The proposal also addresses the importance of pre-filing meetings, the submission of a comprehensive application, public feedback, interagency coordination, and the imposition of conditions. On this latter point, we would like to emphasize that the proposed statement of policy reflects the FDIC's long-standing practice that non-standard conditions should not be used as a means to find favorably on a statutory factor when material concerns are present. By way of example, the proposed statement of policy indicates non-standard conditions or written agreements may be imposed as needed to address capital maintenance requirements, liquidity or funding support, affiliate transactions, the convenience and needs of the community to be served, and other relevant provisions. Such non-standard conditions are designed to address specific risks, unique elements of a filing, matters for which the FDIC would require prior review or approval, or required actions that the FDIC expects management to take following our approval or non-objection to a request or filing. The analyst must independently develop a favorable recommendation on the statutory factor, notwithstanding the imposition of any conditions. We will now spend a few minutes briefly discussing the statutory factors. The narrative regarding the FDIC's analysis of competitive effects emphasizes the identification and evaluation of the competitive environment in the relevant markets, with consideration given as to whether consumers retain meaningful choices. This evaluation includes all relevant financial service providers that compete in the identified geographic and product markets. The proposed statement of policy clarifies that the FDIC's assessment of competitive effects considers concentrations beyond just that of deposits. As appropriate, we may consider concentrations in specific products or customer segments, such as volume of small business or residential loan originations, or other activities that require a specialized expertise. The proposed statement of policy clarifies that the FDIC may require divestitures to be completed before consummation of a merger transaction, and would generally require that the selling institution will not enter into a non-compete agreement with any employee of the divested entity, nor will they enforce any existing non-compete agreements with any of those entities. The proposed statement of policy includes a robust, separate discussion of the financial and managerial resources of both the existing and proposed entities, as well as the future prospects of the resulting institution. The financial resource section affirms the FDIC's expectation that the resulting insured depository institution would reflect sound financial performance and condition. The proposal also specifies that the FDIC would consider the current and projected financial impact of any related entities, including the parent and any key affiliates. With respect to managerial resources, the commentary details the evaluative considerations and expectations, which include assessing management's capabilities to administer the resultant institution's affairs in a safe and sound manner, and effectively implement integration plans and strategies for absorbing the acquired entity. The proposed statement of policy would affirm that the FDIC considers the background and experience of each member of management relative to the size, complexity, and risk profile of the resulting institution. Such evaluations include the nature and extent of organizational relationships, and the proposed statement of policy notes that the FDIC will assess each insured institution's record of compliance with respect to consumer protection, fair lending, and other relevant consumer laws and regulations. With respect to the evaluation of future prospects, this analysis encompasses both the existing and proposed entities involved in the merger transaction. The analysis includes any significant plan changes to the resulting insured depository institution's strategies, operations, products or services, activities, income and expense levels, or other key elements of its business. The proposed statement of policy would affirm that the FDIC expects the resulting institution will maintain an acceptable risk profile. I will now turn it over to my colleague, Sharita Holland, who will discuss the convenience and need statutory factor. Sharita?
Good morning. My name is Sharita Holland, and I am a senior examination specialist in the Fair Lending and CRA Division of Consumer Protection. The convenience and needs of the community to be served section addresses the assessment area considerations, expectations for meeting the needs of the entire community, including low and moderate income neighborhoods, branch closures and relocations, the review of public comments, and the conduct of public hearings. The proposed statement of policy would reflect the FDIC's expectation that a merger between insured depository institutions would enable the resulting institution to better meet the convenience and needs of the community served than would occur absent the merger. The proposed policy statement would affirm that the FDIC will consider the record of each institution in complying with consumer protection requirements and maintaining a sound and effective compliance management system, in addition to having a positive record in serving the convenience and needs of the community. Further, it notes that applicants will be expected to provide forward-looking information to enable the FDIC to evaluate the benefits of the merger on the convenience and needs and hold an institution accountable for the commitments made to the FDIC as a part of the application. Under the proposed statement of policy, projected branch expansions, closures, or consolidations would be expected to cover, at a minimum, the first 3 years following consummation of the merger. The proposed statement of policy states that information should be provided regarding both the timing of each proposed expected closure as well as the effects these closures have on the availability of products and services, particularly to low and moderate income individuals or designated areas. To support the evaluation of convenience and needs in certain transactions, the proposed statement of policy states that public hearings are expected for transactions resulting in an institution with total assets greater than $50 billion, or for which significant number of CRA protests are received. I will now turn the discussion over to Rayanne Miller.
Thank you, Sharita. My name is Rayanne Miller. I'm Senior Deputy Director in the Division of Risk Management Supervision. The discussion regarding the risk to the stability of the United States banking or financial system reflects the FDIC's approach since this factor was added to the Bank Merger Act. The considerations with regard to this factor are generally consistent with the evaluative approaches taken by the Board of Governors of the Federal Reserve System and the Office of the Comptroller of the Currency. The proposed statement of policy describes the considerations for the evaluation of this factor, among which include the size of the entities involved in the transaction. With respect to size, the proposed statement of policy indicates that a resulting institution with total assets in excess of $100 billion is more likely to present potential financial stability concerns and will be subject to heightened scrutiny. The evaluation of this factor also includes the availability of substitute providers for any critical products or services to be offered by the resulting institution, the resulting institution's degree of interconnectedness with the U.S. banking or financial system, the extent to which the resulting institution contributes to the U.S. banking or financial system's complexity, and the extent of the resulting institution's cross-border activities. The proposed statement of policy defines the considerations used to evaluate the effectiveness in combating money laundering and describes potential impediments to favorable findings for this factor. The proposed statement of policy also introduces terms and abbreviations that are used following the adoption of the Anti-Money Laundering Act of 2020. In addition to addressing statutory factors, the proposed statement of policy addresses an area called Other Matters and Considerations, which includes references to the applicability of Section 44 of the Federal Deposit Insurance Act with regard to interstate bank mergers. Additionally, the proposed statement of policy highlights the unique considerations involving applications from non-banks, banks that are not traditional community banks, and operating non-insured entities. Finally, the proposed statement of policy includes a comprehensive list of resources. In closing, the proposed statement of policy would provide added clarity for the public and staff regarding the evaluation of merger transactions and would enhance the effectiveness of the FDIC's framework in meeting the requirements of the Bank Merger Act. The proposed changes to the statement of policy are intended to positively affect the safety and soundness, financial stability, community accountability, and competitiveness of the banking system. That's the end of our prepared remarks, and we are happy to answer any questions.
Thank you all very much. Those presentations were very helpful. I have a statement, and then I'll turn to the other members of the board. Today, the FDIC Board is considering a proposed statement of policy on bank merger transactions. This proposal would update, strengthen, and clarify the FDIC's approach to evaluating transactions subject to its approval under the Bank Merger Act. Given the rapid pace of change and consolidation in the banking industry today, it is vital that the FDIC provide guidance on how it would apply the critical statutory factors under the Bank Merger Act relating to competition, financial resources, the convenience and needs of communities, financial stability, and money laundering. The FDIC's role in evaluating bank mergers actually dates back to 1935, 2 years after the creation of the FDIC, when Congress prohibited any insured bank from merging with any non-insured bank without FDIC approval. Following significant consolidation among insured banks in the 1950s, Congress passed the Bank Merger Act of 1960 to ensure that all mergers between insured depository institutions are subject to the approval of the primary federal regulator of the resulting institution. This framework, codified in the Federal Deposit Insurance Act, remains in place today. As originally enacted, it contained 3 statutory factors that require consideration of the following: monopolistic or anti-competitive effects, the financial and managerial resources and future prospects of the existing and proposed institutions, and the convenience and needs of the community to be served. Congress added 2 additional statutory factors as part of the USA Patriot Act in 2001 and the Dodd-Frank Act in 2010, respectively. Those are the effectiveness of any insured depository institution involved in the proposed merger transaction in combating money laundering activities, and the risk to the stability of the United States banking or financial system. Finally, following the liberalization of interstate merger transactions in the Regal-Neal Interstate Banking and Branching Act of 1994, the Dodd-Frank Act amended the Bank Merger Act to conform the Regal-Neal's general prohibition on approval of an interstate merger that results in an insured depository institution controlling more than 10% of the total deposits of insured depository institutions in the United States. So that is the statutory framework within which the FDIC carries out its responsibilities under the Bank Merger Act today. Now let me turn to our statement of policy. The current FDIC statement of policy on bank merger transactions was last published for comment in 1997 and was subsequently revised in 2002 and 2008. These changes addressed, respectively, the anti-money laundering statutory factor and amendments to the Bank Merger Act resulting from the Financial Services Regulatory Relief Act of 2006. Today, we are considering a new proposed statement of policy that would reflect regulatory, legislative, and industry changes that have occurred over the past 27 years, including the Dodd-Frank Act's adoption of the financial stability factor. This proposed statement of policy includes new content to make it more principles-based, communicates the FDIC Board's expectations regarding the evaluation of merger applications filed pursuant to the Bank Merger Act, and describes the types of applications subject to FDIC approval. While historical performance provides insight into the evaluation of these factors, the statement of policy affirms that the evaluations are forward-looking. So I'll now briefly describe the key considerations for each statutory factor under the statement of policy. First, the Bank Merger Act prohibits the FDIC from approving a merger transaction that would result in a monopoly or would be in furtherance of an attempt to monopolize the business of banking in any part of the United States. The Bank Merger Act also prohibits the FDIC from approving a merger transaction that may substantially lessen competition in any section of the country unless the anti-competitive effects of the proposed transaction are clearly outweighed in the public interest by the probable effect of the transaction in meeting the convenience and needs of the community to be served. For example, such a circumstance may exist where a transaction is necessary to prevent the probable failure of an insured depository institution. The proposed statement of policy approaches the evaluation of competitive effects with the expectation that the resulting institution operate in a competitive environment in which consumers would retain meaningful choices. The evaluation would include all relevant financial services providers that compete in the identified geographic and product markets. The proposed statement of policy would clarify that the FDIC's assessment of competitive effects considers concentrations beyond those based on deposits. The FDIC may consider concentration in any specific products or customer segments, such as the volume of small business or residential loan originations. In cases where divestiture may be necessary, the proposed statement of policy clarifies that divestitures are expected to be completed before consummation of a merger transaction. And further, the proposal would establish a policy against entering into or enforcing non-compete agreements with any employee of the divested entity. The FDIC expects to continue working with the Department of Justice and our fellow banking regulators in carrying out our responsibilities regarding this factor. Now, second, the proposed statement of policy expects that the resulting insured depository institution will reflect sound financial performance and condition. Generally, the FDIC will not find favorably on the financial resources factor if the merger would result in a weaker insured depository institution from an overall financial perspective. The evaluation of managerial resources assesses management's capabilities to administer the resulting IDI's affairs in a safe and sound manner, and its ability to effectively implement integration plans and strategies for absorbing the acquired entity. Managerial resource considerations include the supervisory history, adequacy of succession planning, responsiveness to supervisory recommendations, existing or pending enforcement actions, and recent rapid growth, and management's record in controlling risks associated with such growth. The evaluation of future prospects assesses whether the resulting insured depository institution will be able to operate in a safe and sound manner and maintain an acceptable risk profile on a sustained basis following consummation of the merger. Third, the proposed statement of policy articulates the evaluative considerations used to assess the effectiveness in combating money laundering. Fourth, the proposed statement of policy would clarify and emphasize the FDIC's expectation that a merger subject to its approval will result in an institution that is positioned to better meet the convenience and needs of the community to be served than would occur absent the merger. The proposed statement of policy explains that this may be demonstrated through higher lending limits, greater access to products, services, and facilities, introduction of new or expanded products or services, reduced prices and fees, or other means. The evaluation of this factor includes the proposed assessment area considerations, expectations for meeting the needs of the entire community, including low and moderate income neighborhoods, and a thorough accounting of expected branch expansions, closures, consolidations, and relocations for the first 3 years of the merger. The FDIC's review is broad and not limited to the community reinvestment record of the institution. The FDIC will consider the record of each institution in complying with consumer protection requirements and maintaining a sound and effective compliance management system. In addition, the evaluation will also consider public input. To that end, the proposed statement of policy communicates the FDIC's general expectation to hold hearings for transactions with a resulting institution exceeding $50 billion in assets, or for which a significant number of CRA protests are received. The FDIC may also hold public or private meetings to receive input on the transaction. These mechanisms for gathering additional public input complement the Bank Merger Act's statutory public notice requirements. Now, finally, after the 2008 global financial crisis, the Dodd-Frank Act amended the Bank Merger Act to include a statutory factor related to the risk to the stability of the United States banking or financial system. The proposed statement of policy addresses the evaluation of this factor, which generally reflects the FDIC's approach since the enactment of the Dodd-Frank Act. The FDIC's assessment of the financial stability factor focuses on the size of the entities involved in the transaction, the availability of substitute providers for any critical products or services to be offered by the resulting institution, the resulting institution's degree of interconnectedness with the U.S. banking or financial system, the extent to which the resulting institution contributes to the banking or financial system's complexity, and the extent of the resulting institution's cross-border activities. Although size alone may not be dispositive, the proposed statement of policy indicates that a resulting institution with $100 billion or more in assets is more likely to present potential financial stability concerns and thus will be subject to added scrutiny. The bank failures of 2023 underscore the risks that banks with assets over $100 billion can have for financial stability. So, in conclusion, this proposed statement of policy would update, strengthen, and clarify the FDIC's approach to evaluating mergers under the Bank Merger Act. It follows the FDIC's request for information on the framework applicable to bank mergers. The comments received in response to the 2022 request for information have helped inform the content of this proposed statement of policy, and publishing this proposal for public comment gives the FDIC additional opportunity to benefit from public input. Effective administration of the Bank Merger Act depends on relevant quality information obtained in the applications process. In light of this, concurrent with this proposed statement of policy, the FDIC is seeking comment on proposed revisions to its supplemental section to the Interagency Bank Merger Act application form. Finally, continued engagement with our fellow regulators is vitally important, especially as it relates to evaluating the competitive effects of mergers. The federal banking agencies coordinate with the Department of Justice when evaluating a bank merger's effect on competition, and the FDIC looks forward to continuing to collaborate with our fellow agencies as we consider the appropriate framework for reviewing bank merger transactions. So, for the reasons outlined in this statement, I strongly support publication of this proposed statement of policy for public comment, and we look forward to receiving thoughtful public comment on the proposal. And let me conclude with a word of thanks to the FDIC staff who worked thoughtfully and diligently on this proposed statement of policy and put us in a position to come forward with this proposal today. That concludes my statement, and I'll turn to Vice Chairman Hill.
Thank you, Chairman. I agree that the FDIC's merger approval process needs to be reevaluated and refreshed. Currently, when we receive certain types of merger applications, our process too often breaks down. It takes far too long with too many hurdles and is too unpredictable. The process can be damaging for the institutions involved as they lose employees and customers, and if the merger is approved, extended delays can make integration more challenging. If the target institution is in a vulnerable state, lengthy timelines can be dangerous, as the institution's condition may deteriorate while the application is in limbo, and if the merger is ultimately denied, there may be no alternative options left, as no other potential buyers want to risk waiting more than a year just to get an answer. The proposed statement of policy under consideration today moves in the wrong direction, potentially making the process longer, more difficult, and less predictable. I appreciate that the FDIC plays an important role in evaluating bank merger applications, including by making sure the acquiring institution has the financial and operational capacity to absorb the target firm. But I will vote against the proposed statement for the following reasons. The statement would revise how the FDIC evaluates the competitive effects of a merger and add considerable unpredictability to the analysis. The statement appears to de-emphasize the use of HHI thresholds, which have long served as a predictable proxy for concentrations, and further adds that the FDIC will consider concentrations beyond those based on deposits and may consider concentrations in any specific products or customer segments. The statement gives little clarity on how the agency will decide what products to look at, how such products might be segmented by customer, and how such analysis would feed into the agency's final conclusions. Ultimately, when evaluating the competitive effects of a merger, we should remember that banking has changed dramatically since the bank merger framework was first put in place, when banking was generally a much more local business with heavy restrictions on banks' ability to expand geographically. Today, banking and financial services are generally extremely competitive, with a wide range of readily substitutable financial products and services offered on the internet available anywhere in America. The statement also notes that the FDIC may require divestitures of business lines, branches, or portions thereof prior to the consummation of a merger to mitigate competitive concerns. Requiring divestitures in advance of the merger may add significant delays to the merger process. Meanwhile, failing to successfully divest post-merger is extremely rare, and the FDIC has other supervisory tools to address such a concern. Furthermore, the statement would generally prohibit non-compete agreements with employees of a divested entity, a policy which seems far outside the FDIC's jurisdiction and expertise. The statement also states, quote, generally the FDIC will not find favorably on the financial resources factor if the merger would result in a weaker IDI from an overall financial perspective, end quote. If interpreted literally, this could effectively serve as a prohibition on a broad range of bank mergers. As a general matter, any time an acquiring institution is on stronger financial footing than a target institution, the resulting IDI will initially look worse from a balance sheet perspective. Furthermore, accounting rules generally require an acquiring bank to recognize the target's assets and liabilities at fair value, which, in the current environment, often guarantees that the resulting institution will look weaker financially on day one post-merger. This issue is further exacerbated by the statement's provision that the FDIC, quote, will not use conditions as a means for favorably resolving any statutory factors that otherwise present material concerns, end quote, which suggests applicants could not, for example, raise outside capital to ensure the resulting institution would be stronger from a financial perspective. More generally, why would the FDIC reject efforts by applicants to address or mitigate concerns that arise during the process? Next, I'll turn to the financial stability factor. While the analysis in the statement focuses narrowly on the potential financial stability risks presented by the resulting institution, I think we should consider explicitly focusing on a before and after comparison, one that compares the financial stability risks presented by the two standalone banks to those presented by the resulting institution. For example, if a large bank acquires a very small bank, it might be the case that the acquisition has no material impact whatsoever on the risk to financial stability presented by the large bank, even if the resulting institution has attributes suggesting an unfavorable finding under the framework described in the statement. To give another example, there may be instances in which a strong large bank purchasing a weak large bank would be quite helpful from a financial stability perspective. Last year, if a bank had been willing and able to buy First Republic on an open bank basis, assuming the acquiring institution had the financial and operational capacity to do so, this would have been an unequivocal positive for financial stability, regardless of how the resulting institution measured up under the statement. I think the statement should state explicitly that this would be viewed favorably, even if the target was not yet on the verge of failure. Our analysis should also balance the various ways a merger can add to and subtract from risk to financial stability. Increasing the size and complexity of an institution may add to potential financial stability risks, while diversification of business lines and geography and more sophisticated technology enabled by additional scale may reduce potential financial stability risks. For example, in 2022, If a large bank with a stable, diverse deposit franchise and strong risk management and governance had acquired Silicon Valley Bank with what proved to be an unstable deposit base and relatively unsophisticated risk management, this may have been quite positive for financial stability. The Bank Merger Act requires the FDIC to take into consideration the convenience and needs of the community to be served. The statement would go much further, imposing an affirmative burden on applicants to, quote, demonstrate how the transaction will benefit the public, end quote, and stating that the FDIC, quote, expects that a merger between IDIs will enable the resulting IDI to better meet the convenience and needs of the community to be served than would occur absent the merger, end quote. Burden shifting can make a big difference for a legal regime. For example, there may be examples of mergers in which the merger would benefit the convenience and needs of the community to be served, but the applicants are unable to prove that ex ante to the satisfaction of the FDIC. The statement also suggests the FDIC will closely scrutinize any planned branch closures. While I appreciate the impact the closure of a bank branch can have on a community with limited physical banking options, I think we should avoid presuming that more branch presence is always in the best interest of the community to be served. And we should be mindful of the trade-offs between benefits such as more in-person service and higher costs that are passed on to customers. Additionally, I am skeptical that it is the FDIC's role to closely evaluate whom the resulting entity chooses to employ. The statement also notes that, consistent with longstanding practice, applicants may be offered the opportunity to withdraw an application rather than face a public denial. However, the statement states that the FDIC may still publish a statement describing its concerns with the transaction, which would seem to defeat the purpose of allowing an institution to withdraw. I appreciate the desire to provide more transparency to the public regarding why certain mergers do not get approved, but believe any efforts to do so should avoid imposing reputational damage on applicants. Finally, the statement includes issued and pending enforcement actions as among the concerns likely to result in unfavorable findings. I think this should be limited to enforcement actions that meet a certain materiality threshold and have some nexus to the statutory factors. For example, other agencies sometimes issue enforcement actions that linger for very long periods of time and may be irrelevant to the statutory factors. Using merger policy to address consolidation in the banking industry reminds me of trying to use price and wage controls to address inflation. In both cases, a combination of deeper economic forces and government policies fuel demand, and imposing restrictions on consolidation or prices without addressing the underlying drivers result in a range of undesirable economic inefficiencies. Meanwhile, if/when restrictions are lifted in the future, a vigorous unleashing of pent-up demand quickly undoes the perceived benefits of the prior policy. We should work to develop a regulatory framework that allows banks of all sizes and various business models to flourish, is not biased in favor of one class of banks over others, and otherwise leaves it up to the market and the American people to determine how banking assets are allocated across the system. I want to thank staff for all their work and look forward to the comments.
Thank you. Director McKiernan?
Thank you. Thank you, Mr. Chairman. Thank you also to presenters. Very interesting presentation. Ben, I was particularly struck by your point that the policy really emphasizes, I think you put it well, it's forward-looking and at the combined institutions. That makes a lot of sense to me. I do note maybe some tension perhaps there, this forward-looking perspective with looking backwards at existing past compliance issues, enforcement actions. It'll just be interesting to see how we articulate in our final proposal, our final statement, how we're going to strike that balance and truly ensure that it's forward-looking. You also mentioned that this proposal looks at concentration other than just local deposit share, and that makes a lot of sense to me. We should also be looking at the other product markets. That's another aspect of the proposal I like. And then Shrita, you had mentioned, in assessing convenience and needs, we're going to go beyond just the CRA record. That also I think makes good sense to me. And then Rayanne, I was thinking a little bit more as you were talking about the financial stability risk factor, about this $100 billion threshold that we're introducing here. I think it's hard to argue that there's certainly some greater risk to financial stability associated with mergers that result in larger institutions. But it does also strike me here that one of the potential maybe unintended consequences, again, depending on how we apply this factor going forward, is that we just continue to enhance this moat of regulatory protection that we have around our largest banks, the G-SIBs, right? If we're not going to allow banks to grow to try to compete with those G-SIBs, I'm just not sure that that's actually good from a financial stability perspective. But I suppose the devil's in the detail here and how we're going to apply this going forward. In any event, thank you again for the presentation. Turning to my thoughts here, and I'll submit a longer statement for the record. But what I'll just say is, I guess a little more than a year here at the FDIC, I've been struck by how long some of our merger applications, other applications have been stuck with the FDIC. Some of our merger applications have been here more than a year. And I've speculated in a speech or two that some of this delay might be due to maybe an evolution in our policy on mergers, perhaps to reflect lessons learned from the '08 crisis. I mean, this is a 25-year-old or more policy statement that we have currently. Perhaps also to reflect the lessons learned from last March, and it'd be appropriate for us to continue to incorporate those lessons learned into our merger policy. But I've also suggested that if that's the case, if it's the case that our merger policy has indeed evolved, then I think it's incumbent upon us as a building to update that policy and then timely consider applications against that policy. And so in that sense, I welcome today's policy. I think it is timely to revisit our merger policy. I think this is potentially a good step towards transparency and maybe, hopefully, timely consider our merger applications. On the other hand, it's unfortunate that this merger policy, I think, really just makes explicit what we all kind of already knew, which is that the FDIC takes a quite skeptical view of mergers. And so I won't be able to support this proposal because I think it really reflects and implements a bias against mergers that is, at the end of the day, bad policy and also contrary to law. My longer statement, my written statement that I'll submit for the record, gets into some specific examples. Vice Chairman Hill hit on many of these already, so I'll just maybe flag one in particular. And that's our approach to mergers that involve mostly rural markets. So really, it's the lack of a tailored approach to rural markets. So, I think I do have some concerns that our general approach to considering mergers, even if it's not based just on local deposit share, even if we move beyond HHI and other measures, similar measures, I have concerns that this general approach has some unintended consequences for mergers in these rural markets. When you have a focus on deposit share or even lending other products in those kind of smaller geographic markets, what it's hard to take into account of is the extent to which individuals in those rural markets are getting services from credit unions, the farm credit system, non-banks, even from outside the community. And so as a result, under our kind of general approach to mergers, I do worry that we're actually discouraging mergers between two community banks in that locality, banks that actually know the community, actually are incented to serve the community, and instead favoring acquisitions by larger banks from outside the community of those community banks. This is particularly relevant to the extent that increasing regulatory costs, other pressures really are driving consolidation among some of our community banks. Again, I've got other examples of, I think, this bias against mergers that I see reflected, I think, in this proposal. But I do look forward to comments on the proposal, and I hope I'll be able to support a final statement of policy that maybe takes a more balanced approach. Thank you, Mr. Chairman.
Thank you. Director Sue?
Thank you, Chairman Grunberg, and apologies in advance for my voice. Allergy season is winning in DC right now. So I support the FDIC's proposed statement of policy on bank merger transactions and its publication in the Federal Register. The proposed statement of policy aims to improve bank merger application outcomes and is broadly consistent with the proposed policy statement issued by the OCC in January. Both are intended to provide additional transparency around the agency's reviews of applications under the Bank Merger Act. Bank mergers applications exist along a spectrum. They are neither all good nor all bad. By faithfully applying on a case-by-case basis the Bank Merger Act statutory factors, the diversity and dynamism of the U.S. banking system can be maintained and strengthened. Healthy bank mergers, i.e. those that benefit communities, support bank resilience and financial stability, and enhance competition, should be approved. Merger applications that would diminish competition, hurt communities, or present systemic risks should be withdrawn or rejected. Today's proposed statement of policy, like the OCC's, aims to offer further clarity into how the statutory factors will be weighed to achieve those outcomes. On the issue of conditions, the proposed statement of policy provides that the FDIC will not use conditions as a means for favorably resolving any statutory factors that otherwise present material concerns. I concur with this approach. At the same time, in some instances, targeted conditions can mitigate specific risks from a proposed merger transaction. These should be considered when they will be effective and where appropriate. I want to thank FDIC staff for your hard work on the proposed statement of policy. I encourage all stakeholders and interested parties to provide comments. Thank you.
Thank you. Director Chopra?
Thank you, Mr. Chairman, and thanks all of you for all the work really that has been going on now for a few years since we launched the review of the Bank Merger Act framework. Let me just share a couple of observations of really what our status quo has been before this review. I think our status quo was completely biased against transactions involving small institutions that would immediately trip all the lines. We had a long, iterative process that seemed almost interminable with, frankly, a thought of getting to yes rather than calling balls and strikes. We had significant information deficits in how we approach things. And I'm just really glad that we are moving away from a pro-merger policy posture and moving to the text of the statutes that Congress has passed. I want to just go through, for the benefit of the record, a couple of questions on certain topics. I think these are some of the topics in the policy statement for which we're going to want additional feedback, not just to finalize a statement, but also to really put it into practice. I appreciate a lot of the comments other board members have made, and I apologize if some of it is a little bit repetitive. So let me start with the issue of assessing competitive effects. Of course, that first prong of the Bank Merger Act with respect to anti-competitive effects. In case law, we know that it has some corollaries to the existing statutes, the Sherman Act, the Clayton Act, the FTC Act, others. And I think one of the places that is very good for us to continue to codify is reviewing competitive effects using modern empirical methods. So there has been quite an emphasis on deposit market shares. I think we all know, based on our own assessments of customer segments, we know that, for example, a smaller local business will not simply deposit, but will also get other ancillary services, including lending. We know that mid-market, regionally operating businesses need additional services in a almost one-stop shop. These are considered cluster markets, that people are not just looking for one particular product, but they need a basket of services together. And we see this in all parts of our life, in how we shop in retail, at supermarkets, to how large industrial conglomerates purchase their own goods and services. So let me just ask, I think, to be fair, the FDIC and the OCC and the Fed actually do look beyond deposit shares, but I think haven't put as much transparency into what products they will look at. So I wonder if you could share with us some of the analyses that the agency might conduct beyond deposit shares as part of this analysis.
Thank you for the question, Director Chopra. My name is Ryan Singer. I'm with the Division of Insurance and Research here at the FDIC, Section Chief for Regulatory Analysis. So beyond deposits, we will look at certain products like small business lending, middle market lending, other types of products and services, single-family residential mortgages, to the extent that they are relevant to the particular transaction. And as you say, some of those services extend beyond deposit share local market.
Good. And I think part of the way that a lot of merger analysis is being conducted here in the US, abroad, is really looking at different customer segments and customer tiers. So for example, there may be banks that specialize in poultry lending, specialize in providing services to certain types of business within a region or locality. Looking at customer segments and clusters is going to be important, I think, as we do this analysis. Let me raise this issue of withdrawals. The data that we are releasing alongside the proposed policy statement, which covers 2004 to 2023, shows that the FDIC did not deny a merger in that time period. Now, of course, there were mergers the agency did not think should be approved, and either went through a very significant process in terms of time to fashion remedies or conditions, or there was an option for the applicant to withdraw. And I want to, this is an important part of the policy statement. When we map about what other agencies do with respect to terminations of proposed mergers or withdrawal of applications, there is no transparency really about the reasons for the agency's concerns. So the market is actually left with no denial orders to look at, nor any summaries, even anonymized summaries about the types of concerns that came about in the review. That creates even more of a mystery for boards and officers exploring mergers, because it becomes a little bit of a crapshoot about what is going to happen. So I think this question about benefits and risks of withdrawals is one we really need to seriously think about shifting on. And there are some cases, and I really appreciate the discussions with staff about this, where we would want to be quite careful about describing the concerns that led to the merger's denial. In other cases, we may have fewer concerns. I wonder if you could just share some of the thinking around the policy statement's commentary around withdrawal versus denial orders and related issues.
Thanks very much. I'll take that question, and I agree with you. I mean, as you point out, we do not have any withdrawals in the statement in the period covered by the case. We do have a little over 5% of the applications were withdrawn, and I go back to what Vice Chairman Hill said. You know, we do value the back and forth and the iterative process we have with the applicants, and we find that very useful for them so that they can get the best possible application before us, as well as for us, so that we can evaluate with as much information as we have. For those 5.4% that were withdrawn, it's likely that that we had that extensive discussion with the applicants, and that the potential impediments have been already conveyed to the applicant during that process. We have an existing instruction that at our discretion, we may allow the applicants to withdraw the application. And this applies to not just merger applications, but other applications. So getting back to your questions, I mean, the benefits to that is that the applicant might not have a public denial. We're not placed in the position of conveying confidential, perhaps supervisory information that could be damaging to the institution. The risks to such an approach are just what you mentioned. It's not, we don't have transparency for others who might apply and might get a sense of essentially what wouldn't be acceptable. And so we think in some respects, transparency there could be instructive to future applicants. So to address this comment in the case, we talk about making the public aware that the FDIC board may, in certain circumstances, publish a statement with respect to a withdrawn application, including the risks and impediments to approval. The proposed policy statement indicates, and I quote, "If an applicant withdraws their filing, the FDIC board may release a statement regarding the concerns with the transaction if such a statement is considered to be in the public interest for purposes of creating transparency for the public and future applicants." So, we certainly look forward. This would be something new for us in getting comments on that.
Terrific. And I think we have seen how other agencies do publish these types of statements, particularly to describe some of the competitive effects analysis. There are other factors that I think are relevant that would not jeopardize safety and soundness of the institution. I think we want to make sure that we are thinking of all the ways to be upfront about where concerns have been identified. The CFPB, the FDIC, others, for example, publish supervisory highlights publications. These are also anonymized that describe some supervisory findings. This both protects confidentiality on a summary basis, but it also gives some direction to the market. I think we should consider both public statements on specific transactions, the value of denial orders, as well as other ways to communicate that. Rayanne, you mentioned sort of the discussions with merger applicants. I think there seems to be two separate issues here. One is the issue of process, and two is the issue of where one draws the line in terms of permissibility of a merger. On process, I think continuing to think about how we explain competitive effects analysis, convenience and needs analysis, others, will give more ability to a board and management to get a sense of what is my chances here, have a little bit more of an informed ability of knowing the likelihood of approval, and in some ways be able to prepare in advance of that application. I think there are also a number of benefits to speed the process up if the applicants really know more upfront. This brings me to the question of information gaps. You raise in the proposed policy statement, and our action today will also look at supplementing the existing bank merger application with additional information. Let me just share that when you look at the information requirements, when there is an application filed and supplemental information asked after the application, this is also a contributor to lengthy reviews. And I think during our review that we launched when we solicited comment in the Federal Register, one significant issue that I identified was the gap between the information collected in Hart-Scott-Rodino Act merger notifications and the information we collect in Bank Merger Act applications. There are several items in the Hart-Scott-Rodino Act notification that give pretty good information about how to evaluate competitive effects. It seems better to ask for this up front rather than wait and ask later, so that an applicant really provides all the information in order for an assessment and ideally disposition rather quickly. I wonder if you could share a little bit more details about what we are looking at and what the action we're taking today supplements in terms of information in the application.
So thank you. I think the general approach here is to give some more information. And one of the reasons why we wanted to expand our SOP was to provide as much information to the applicants for what a successful application would look like. We didn't mention this in our prepared remarks, but coincident with this SOP, we will also be issuing a supplement to the there is an interagency Bank Merger Act application, and each agency has its own supplement that over time has evolved to suit the different needs of the agencies and the different entities that we supervise. Today, we're going to be publishing under the Paperwork Reduction Act for comment revisions to our supplement, and part of those revisions will include some of the comments that you made to cover some of the provisions of the Hart-Scott-Rodino Act, and they focused on asking upfront to give us information that the bank's boards have looked at when evaluating the merger. In other words, who else did they review? What other deals did they consider? Was this the only game in town? To kind of get an idea of the breadth of the board's decisions in this regard. And hopefully that will help, again, as much information upfront could help reduce the time in processing and the need to go back for additional information requests.
That's good. And I think as we continue to reflect on the economic learning about competitive effects and about our own analysis across the economy about the impacts of mergers, retrospective analyses are important, and knowing whether the predictions we had about the benefits of mergers came true, those predictions can be more informed by a number of the items that we are seeking to supplement. I'll reflect on a financial industry merger from a couple years ago, I believe in 2019 or 2020, Visa's proposed acquisition of Plaid. This is not a Bank Merger Act covered transaction, but the analysis revealed quite a bit about deal rationale. The deal rationale where evidence suggested that senior executives in Visa saw the acquisition as an insurance policy for protecting their own business, a kind of classic catch and kill merger. So we need to make sure we understand the deal rationale, how boards and others deliberated about it just as is done under the Hart-Scott-Rodino Act notification framework. Let me shift now to the issue of convenience and needs to the community. So I think that this is actually a very important part of the proposed policy statement. I'll just note that the Bank Merger Act predates the passage of the Community Reinvestment Act. The Community Reinvestment Act is not fully coextensive with convenience and needs analysis. Under the policy statement, if one or both banks have a satisfactory or even outstanding rating, that would obviously not be a bad thing in merger review. But I wonder if you could share a bit more about the forward-looking nature of the convenience and needs review. And you mentioned several aspects of it, which I appreciate. I wonder if you wanted to add any more color on the types of things the agency would consider.
Certainly, thank you for the question. When considering the convenience and needs statutory factor, we do look at a number of elements within the transaction. We look at the services that are specific to each institution, which of those services and products will continue or discontinue, and the impact that that may have. We've always looked at the forward-looking and the resulting institution, and this policy makes it clearer and more transparent to the applicant in applying or when they're applying to provide that information. So there's nothing new here that we're doing. We're just extending it as far as the offering that's what we're looking for and the expectation from the FDIC.
Great, and I'll note that during the review that we launched 2 years ago, there was a number of, some discussion by the commenters, stakeholders, others about community benefits agreements. And I think one of the challenges of community benefits agreements is that they're typically not codified in an order, and therefore enforceability around those is challenging. And I think what is good is the agency is going to be taking more personal responsibility for the assessment of the convenience and needs factor. And should it be denied on that basis, we would be forced to articulate in a denial order our analysis. And I think that is good government and transparency, and also ensures that the purported benefits of a transaction really can be actualized if they exist at all. Let's shift to financial stability. I really want to echo the comments made by the chairman about financial stability. One of the things that we had heard through the process of the review was that, well, you know, when two large institutions get even larger, they may be pushed into a new regulatory tier, and ta-da, you know, that financial stability concerns are solved. To me, the challenge with this line of thinking is that that renders the congressional amendments in 2010 as moot. That existed prior to the 2010 amendments. Those words have to mean something. And I think there are questions over the past decade about what they have meant. And when we do an assessment, when we've conducted the assessment of previous approval orders by the three banking agencies, we find quite a bit of heterogeneity in how much information was explained about the assessment of the financial stability factor. So I think this is good that we're actually putting some real words on paper about how we would look at it. I echo what the acting comptroller has said about the OCC is taking steps as well to explain how that factor will be interpreted. So I guess, let me ask you this, in the financial stability analysis, how will the agency consider at the staff level potential contagion concerns associated with the failure of the combined entity, and why could that be an important variable to consider?
So I just want to get to your point about ta-da, too. There is no ta-da. We have no check-the-box process, and we look at every merger on a case-by-case basis. And I appreciate your comments about the risk of contagion. And I think certainly, as demonstrated by last year's failures, it's a serious issue and one that hits at below the GSIB level. So it's very serious for us. I mean, we outline our factors, and again, not a check the box, but among other things, we're going to be looking at financial interconnections with other market participants. That could be through things like derivative contracts, through things like asset liquidations that could disrupt markets. We'd also consider operational matters, such as the potential for disruptions in key services that other financial market participants depend on. And in this case, the idea of potential substitutes are implicated in the event that a party that provides a key service somehow goes away. So again, we mentioned about contagion. I think it's going to be a central consideration with financial stability, and certainly looking at, it's a new, 2010 doesn't seem like it's new, but it's a newish factor for us, and so we're certainly looking for comments how we could do better in our policy statement in telling people how we're going to be looking at this. But it is, I want to just assure you, not a check the box and ta-da.
Great. Let me shift now to the issue of, and I appreciate the board's indulgence on some of these issues. On the question of planning for integration, we at the CFPB really have identified and observed in the context of major transfers of accounts and loans, mergers, significant challenges with respect to consumer access to accounts, funds. We have observed this in other contexts. I want to just ask you to comment a little bit more about how we are thinking from a supervisory perspective and application review perspective about integration planning. Integration planning is so key from a safety and soundness perspective as well, given the role of information technology systems. But of course, the consumer harm from a botched integration can be very significant. So I wonder if you could just share a bit about what we are thinking through in terms of making sure the institution merging parties would be prepared should they receive a favorable determination on their application.
Thank you, Director Chopra. It's an excellent question. A lot of the areas that you touched on in the example were primarily sort of IT related, right? But when we look at integration and we're evaluating a merger application, it's far beyond just the IT aspect, which is very important. We also look at human capital, products and services, policies and procedures, the extent of the internal control and audit functions, the physical locations, risk management programs. So it's a pretty diverse set of factors that we're considering when we're looking at how effectively the institution can be integrated. So we look for management's ability, right? Can you prove to us, can you show in the past that you've been able to successfully integrate institutions? Do you have the requisite knowledge and expertise? Again, some of the other items I mentioned, like internal controls. What's the previous experience in integrating an institution? Have they been successful at prior merger transactions? And how effectively do they plan for and respond to risks that arise from the transaction, such as changing business conditions, introduction of new products and services, the accuracy and timeliness of information, depending, again, on the size and the complexity and risk profile, as well as the physical elements, right? The system's capability, hardware, products and services, physical elements, et cetera. So all of those things together are all looked at in integration to make sure that, again, the institution that's being acquired will be able to be integrated effectively, and the resulting institution will not have additional concerns that may be remedied in the institution that was acquired.
Terrific. And I think that behooves us to continuously reflect on supervisory issues that we identify of our existing institutions. I think a number of the agencies have seen failed merger integration, or at least messy merger integration, as having significant downstream effects with respect to consumer, with respect to the ability to even calculate or understand their financial condition, and on and on and on. I think this is a very important piece of where institutions that are looking or exploring transactions, this will be a major focus as part of it. Let me shift to the issue of remedy. I think it is important for us to constantly be thinking about the incentives of merging parties when executing certain remedial aspects of an approval order from the agencies, from the FDIC. I want to specifically highlight for the record the FDIC's work in its approval order in the Umpqua-Columbia merger, whereby the FDIC imposed certain requirements that I think are much more in line with how other agencies across the United States think about divestitures. Importantly, we should reflect that the incentives of merging parties, when they have to divest a branch or other business, is to sabotage their future competitor. When divesting a branch that is across the street, do you really think that merging parties want that branch to be successful? They have every incentive to make it decay and every incentive to create mischief. One of the things that we are codifying in this policy statement is a clearly disfavoring post-close divestitures. A divestiture that occurs post-close immediately has competitive harm that goes unremedied. And in addition, ensuring that there are other provisions to make sure that merging parties cannot sabotage a divestiture buyer. And one of the best examples of that type of sabotage is enforcing non-compete agreements against the employees and managers of businesses that are being divested. In a divestiture remedy, we should want that entity to fully replace the competitive intensity that was lost, and the ability to block those employees who have relationships, have knowledge, and make them start from scratch. I think this is a very important part of thinking about our remedial toolkit and orders. So, George, you raised the issue of post-close divestitures, ensuring that merging parties can't sabotage through the enforcement of non-compete agreements. Just wanted to check, I wanted to see, is that the reason for ensuring, is that the rationale for incorporating that in the policy statement?
Yeah, Director Chopra, yes, that's primarily the reason. The one key thing we'd like to emphasize is that by having it up front before consummation, you're minimizing the risk that that remedy will be ineffective. And that's really the goal behind the statement.
Terrific. I want to just make a couple of other comments. I appreciate all of the answers to these questions. I think having them for the record will also help in some of the comment process as well as implementation downstream. I do want to make a remark about the issue of moats. I think we did hear during the comment period that having a more textualist-driven merger review process will protect those who already benefited from merger sprees. I think this Bank Merger Act review really complements some of the other things the FDIC is pursuing to ensure the safety and soundness of the largest depository institutions and ideally to take away the implicit subsidy they are already receiving that gets an unfair competitive advantage. To me, the answer is not to lurch into a European or Chinese style banking structure where there is just a handful of very large banks. We want to preserve the heterogeneous size and character of the U.S. banking system, but also make sure that the unfair competitive advantages enjoyed by the very largest in forms of cost of funding and many others, that we level the playing field through other policy initiatives that we are pursuing. I have a brief statement, and I will submit a longer one for the record. Today, the FDIC Board is voting to propose a new policy statement on the Bank Merger Act. I support the proposal as it represents a continued shift and it represents reflection about merger policy over the past decades. We have seen how banks have grown larger and more complex through mergers enabled by the agency. We should not be pro-merger, anti-merger. We should call balls and strikes just like the statutes require. Our statutes certainly have skepticism about inorganic growth, which should be reflected in how we approach our work. We have seen how small businesses, family farms, and others can see the consequences of competitive harm in the form of worse customer service, higher fees and interest rates, branch closures, lower rates paid on deposits, and more. Let me briefly highlight 5 features of the policy statement. First, it outlines that the agency will engage in a more rigorous analysis of competitive effects, looking beyond local deposit market share. The agency will look at how banks compete in markets for other products and services across different customer segments in local, national, and regional geographies. This policy statement also ensures a robust review when considering the impact of the transaction on the convenience and needs of the community. This is a forward-looking analysis in which the agency will evaluate whether the community will be better served by the combined firm than it was prior. This will require specific evidence from the applicant, not vague, consulted, drafted platitudes. Third, for the first time, the policy statement describes the agency's financial stability analysis. This factor was added in 2010 after the bailouts and financial crisis. Transactions involving banks with $100 billion or more assets will receive heightened scrutiny. The existence of separate financial stability safeguards does not somehow delete the text of the statute. Fourth, the policy statement begins to address a concern from many stakeholders about agencies' use of withdrawals, denying the public and future applicants with clarity as to the agency's concerns. I do support, in the appropriate cases, more public denial orders, and the policy statement's assertion that the board may release a statement when it's in the public interest expressing the reasons an applicant withdrew is a step in the right direction and conforms to other agencies engaged in merger review. Finally, and this one's very important, to engage in proper review in an appropriate time period, we need better information up front. The agency is releasing an updated application form pursuant to the Paperwork Reduction Act that, among other things, will require production of certain analyses prepared for bank directors, officers, third-party investment bankers, consultants, and others to better understand deal rationale. So again, I really look forward to the comments on this and really thank you all for all the work that has gone into thinking through this very, very significant policy issue. Thank you, Mr. Chairman.
Thank you. Any other comment from members of the board? If I may, let me thank all of our members for their very thoughtful statements that I really think add value to the public's consideration of the proposal we're putting forward today. With that, may I have a motion with respect to the proposed bank merger policy? Thank you. In a second?
Second.
I'll now call the roll for a vote. I vote aye. Vice Chairman Hill?
No.
Director McKiernan?
No.
Director Su?
Aye.
Director Chopra?
Aye.
Thank you. The motion is adopted. That concludes the discussion agenda for today's meeting. Is there any other business that any member of the board would like to raise? If not, we'll now adjourn the open meeting and move into closed session. Thank you all very much, and thanks once more to the staff for their excellent work.